Hello everyone, welcome to EduTap and welcome to today's session. I hope I am clearly audible and visible first of all, and in today's session we are going to discuss a very important RBI press release. The Reserve Bank of India has released the monetary policy statement, that is after the meeting of Monetary Policy Committee that recently concluded. Okay, so Monetary Policy Statement, this is a very important statement that the RBI has released in its press release, and this is released after the recent Monetary Policy Committee meeting, and this is a very important statement that we are going to discuss in today's session. As you know that recently the Trump government has imposed tariff on various countries, and this has led to some impacts on India also. So how the Monetary Policy Committee is going to tackle that, what decisions have been taken in this regards. So all of this we are going to discuss, as well as we will discuss the Monetary Policy Committee's outlook for growth and inflation. So what important data points the Monetary Policy Committee has said in this April meeting. Okay, so all of this we are going to discuss in today's session. Audible? Okay. So hello and good morning everyone. So I hope that you know that how important this meeting is. The RBI has decreased the repo rate. What is the meaning of this and what are the data points that the MPC has released? All of this we are going to discuss in today's session. This is important from your objective as well as descriptive point of view. Okay. So let's get started without any delay. But before that, do subscribe to the YouTube channel of EduTap and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below, and usually the PDFs are uploaded within 24 hours of the session. Okay, so now starting with the Monetary Policy Statement for 2025-26, that is released after the Monetary Policy Committee meeting that was conducted from April 7th to April 9th. Okay, so just yesterday the Monetary Policy Committee meeting concluded, and after that RBI released the Monetary Policy Statement. Okay, so Monetary Policy Committee held its 54th meeting. So this was the 54th meeting of the Monetary Policy Committee, and as you know, I hope many of you know that Monetary Policy Committee, this consists of 6 members. This consists of 6 members. 3 members are nominated by the Government of India, and the 3 members are from the Reserve Bank of India. Among these 3 members that are from the Reserve Bank of India, there is the RBI Governor, that is the member, as well as RBI Governor is the chairman of this Monetary Policy Committee. Okay, so here you can see that the Monetary Policy Committee held its 54th meeting under the chairmanship of Shri Sanjay Malhotra, who is the RBI Governor, and the MPC members were Dr. Nagesh Kumar, Shri Gata Bhattacharya, Professor Ram Singh, Dr. Rajiv Ranjan, and Shri M. Rajeshwar Rao. These attended the meeting. That means all the 6 members of the MPC, they attended the meeting, and there is a unanimous decision that has been taken. There is a unanimous decision that has been taken to reduce the repo rate. So why this decision has been taken, that we have to understand. So first of all, after assessing the current and the evolving macroeconomic situation, the macroeconomic situation was assessed, and it was seen that what is the situation of the whole of the country, and then the MPC has taken the unanimous voting, and the unanimous decision has been taken to reduce the repo rate. Now, if you know about the repo rate, it is the rate at which the RBI provides loan to the banks. Okay, so banks take loan from the Reserve Bank of India at the repo rate. Now, the banks have to provide a collateral in the form of government security while taking the loan from the Reserve Bank of India. Okay, so let's say that the repo rate is decreased. That means the banks will get cheaper loans from the RBI. The bank will get cheaper loan from the RBI if the repo rate is decreased. That means this is the interest rate. This is the interest rate at which RBI is lending to the banks. So if repo rate is decreased, so for banks it is cheaper to take loans from the RBI. So if it is cheaper for banks to take loan from RBI, the banks will also provide loans to the customers in the country at a cheaper interest rate, at a lesser interest rate. Now at a lesser interest rate, more people will want to take home loans, more people will want to take car loans, and the loans for their wedding, the personal loans and such. So at the lower interest rate, the loans taken by the customers will increase, the loans taken by the people in the country will increase, and with more loans there will be more money that will flow into the market. With more money there will be more demand. With more demand there will be more production in the country, and so the economic growth will get boosted in the country. I hope this is very much clear. Okay, so this is the idea that if repo rate is decreased, the repo rate is decreased to boost the growth, to boost the production, to boost the growth in the country. Okay, So this is the idea. So RBI decreases the repo rate, that is the interest rate at which the RBI is providing loans to the bank. So this is repo rate is decreased to boost the growth in the country, because if RBI is lending at a lesser interest rate, RBI is lending at a lesser repo rate to the banks, banks will lend at a lesser interest rate to the customers. So this will make the customers take more loans. This will make the people take more loans in the country. The people will take more loans at a lesser interest rate, and so there will be more money supply in the economy, there will be more demand, more production in the economy, and the economic growth will happen. Okay, now usually the repo rate is increased. Why the repo rate is increased? So RBI increases the repo rate to decrease the inflation in the country, okay. So RBI increases the repo rate to control the inflation, but RBI decreases the repo rate to boost the growth in the country. So if RBI wants to boost the growth, RBI has to reduce the repo rate. If RBI has to control the inflation, RBI has to increase the repo rate. So now the RBI has decided to decrease the repo rate by 25 basis points. That means the repo rate was before 6.25%. Now the RBI has decided to decrease the repo rate to 6%. That is by 25 basis points. That is by 0.25%. The repo rate has been decreased. So repo rate has been decreased to boost the growth in the country. Okay, now why this decision has been taken, that we will understand when we are able to see the data points in the growth and the inflation outlook, that why there is the requirement to boost the growth, why the RBI is not thinking of increasing the repo rate to control the inflation. Now is there no requirement to control the inflation? What is the scenario? So that we will understand, then you will be able to understand that why the RBI has reduced the repo rate. But for now, just keep in mind that RBI has reduced the repo rate by 25 basis points from 6.25% to 6%. So now the repo rate is 6%. Okay, so now the repo rate is 6%. Now the SDF rate is less than the repo rate by 0.25%. And the MSF rate and bank rate, so MSF rate is more than the repo rate by 0.25%. Okay, so before the repo rate was 6.25%, so SDF rate was 6% and the MSF rate was 6.5%. Now the repo rate has decreased to 6%, so the SDF rate has decreased to 5.75% and MSF rate has decreased to 6.25%. Okay, so always remember that the MSF rate is greater than the repo rate by 0.25%. So if the repo rate is 6%, MSF will be 6.25%, and the SDF is less than the repo rate by 0.25%. So if repo rate is 6%, the SDF rate is 5.75%. Okay, so this is the idea. Before the repo rate was 6.25%. Now it has decreased to 6% and SDF rate has come to 5.75% and MSF rate has come to 6.25%. This is known as LAF corridor. This is the LAF, Liquidity Adjustment Facility corridor. Okay. Now SDF rate is the deposit rate. It is the deposit rate at which the RBI take the deposit from the banks. Okay. And the RBI pay this rate to the banks for their deposit to the RBI. So SDF rate is the rate at which the RBI is taking the deposits from the bank. Okay. MSF rate is the rate at which the RBI lends to the bank if they have utilized the facility, if they have utilized the complete loan that they can take under the repo rate. So banks, they can take a limit of loans under the repo rate. Once the bank has utilized the limit, then they can take the loan under the MSF rate, but MSF rate is a higher rate that you can understand. That's why it is also called penal rate. And bank rate is always equal to MSF rate. So this decision has been taken to reduce the policy rate by 25 basis point by 0.25%. So from 6.25%, the repo rate has been decreased to 6%. SDF rate has become 5.75%. MSF rate has become 6.25%. Okay. Now this decision is in connoissance with the objective of achieving the medium term target for consumer price index inflation of 4%. So the inflation target is 4% plus minus 2%. The RBI wants the inflation to remain within the range of, to remain around 4%, within the range of plus 2%, that is 6%, and minus 2%, that is 2%. Okay. So this is the inflation target, that is the RBI wants the inflation, the MPC wants the inflation to be around 4%, within the range of 2%, that is lower tolerance level, and 6%, that is upper tolerance level. RBI do not want the inflation to go above 6%. RBI do not want inflation to go below 2%. Now this is the range that is present. Okay. Now the decision of decreasing the repo rate is not harming the objective of achieving the inflation target. Actually, we are being able to achieve the inflation target even by reducing the repo rate. That we will understand that why this is happening. Okay. So this is the basic idea. Any confusion till now? So I hope this is clear till now. I have given you the basic idea of the different terminologies also, but this is from the static point of view. You have to get more knowledge in the static, but I have given you the brief idea. Now coming to the growth and inflation outlook, now here you have to be more attentive, because here you will understand that why the RBI is decreasing the repo rate. Okay, so the recent trade tariff related measures, so you can understand that recently the US has taken the tariff measures, and the US has increased the tariff on various countries, on India, China, Vietnam, various countries. The tariffs have been increased. Okay, now in retaliation, China is also increasing tariffs on US, and there is a trade war that is seemingly getting started. Okay, so recent trade tariff related measures that is specifically taken by US first, this has increased the uncertainties that is clouding the economic outlook across regions, that is affecting the economic outlook across regions. This is posing new headwinds. Before, we had to fight with the COVID-19. Before, there was the problem of COVID-19 that affected the growth of our country. The production, for the time being, the factories were in lockdown, so the production was reduced, the growth was reduced. Then there came the Russia-Ukraine war, which led to huge inflation, and due to that, we had to control the demand in the country so that the inflation do not become too much to handle. So then the Russia-Ukraine war was there. Now the tariffs have been imposed by the US just when we thought that, okay, now the Russia-Ukraine war is becoming a kind of old problem. So now the US has imposed the tariff and has started a new problem in the world. Okay, so the recent trade tariff measures have increased the uncertainties in the economic outlook across regions. So what will be the impact of this tariff? You can understand that, let's say India is selling an electronic product at ₹100. Okay, India is exporting the electronic product at ₹100 to US, and US is importing this electronic product. The US citizens, they are very happy to get this product at ₹100. Okay, now let's say that the US has imposed, just take an example, that let's say US has imposed a tariff of 26% on this electronic product. This tariff is like a tax that is imposed on the imported goods. US is importing the electronic product, so on the imported goods, the US is imposing the tariff, and on this electronic product, the US has imposed the tariff of 26%. So now this product will be of how much price? What will be the price of this product? If anyone can tell me, what will be the price of this product now? It will be 126. It will be 126 rupees. Okay, now the US citizens, they were before getting the same product at 100 rupees. Now they will have to pay 126 rupees to get this product. So for the US citizens, the product has become expensive. The price of this product for the US citizens is increasing. Now at the higher price, the demand for the electronic product will decrease in US, right? At the higher price, the demand reduces. So if the US citizens are demanding less of electronic product, that means India will be able to export less of electronic products. If India is exporting less electronic products, that means we will be producing less electronic products. So with the decreasing demand, with the decreasing demand from US, the production, the trade, the export, they are going to reduce. So it is going to affect India. Not only India, as it is said that this tariff is imposed on various countries, so it is going to affect various countries in the world. So that's why it is said that recessionary tendency might come, because in recession what happens, that demand decreases, production decreases, the income decreases, and further demand decreases. With decreasing income, further demand decreases, further production decreases, and there is a spiral, recessionary spiral. So it is said that maybe this US tariff is leading the world towards the recessionary spiral, though the RBI has said that anything can happen. For now, we cannot judge it. Okay, so this is the idea. So you can understand that India was exporting a product now to US. Now on the import of US, US was importing the product. So on imports, the US has imposed heavy tariffs. Very heavy tariffs have been imposed by the US, and that is going to reduce the demand for the imported good from India. So the export will reduce from India. Okay, so recent trade tariff related measures have increased the uncertainties, posing new problems, new headwinds for the global growth and inflation. Financial markets have responded through sharp fall in dollar index. So dollar index, this is the dollar index, this is the US dollar index, measures the strength or weakness of the US dollar in the forex market. A increase in dollar index shows that the dollar is becoming stronger, but a fall in dollar index shows that the dollar is becoming weaker against the currency, against the other currencies, against a basket of other currencies. Okay, so fall in dollar index means now dollar is becoming weaker. And equity sell off, that means in the financial market, the shares of many company in US have been sold off. The share market fall very much because the people became very agitated, they become very confused, they became very speculative that what is going to happen now with the country, in the world. Okay, so equity sell off happened and the share market fall down very much, not only in US but in India and in other countries also, with significant reduction in the returns, in the bond returns. That is, the bond returns are also reducing and the crude oil prices are also reducing. So you can understand that a decision by US has impacted the whole of the world very much. Financial markets have responded very badly by weakening the dollars, by share market decline and the softening or reduction in the bond returns. Now the NSO, that is National Statistical Office. So this is the global condition that is impacting the India. Okay. Now NSO has estimated the real GDP growth at 6.5% for 2024-25 on top of the 9.2% growth in 2023-24. Okay. Now this is for the previous years. This is the expectation for the previous year. Now going forward, see, India is a big country and the good thing is that we have enough of the population to tackle the problem, because in our country, if the exports are reducing, the production will reduce. If the exports are reducing, because in the US the demand will reduce because of the tariffs, the demand is going to reduce, so exports will reduce of our country. From India, exports will reduce, production will reduce, but at least we have enough population that if we people keep on demanding the products as we are demanding right now, so the demand in our country, that is the domestic demand, will not be impacted much, and the production, even though it is reducing with the reduced exports, it will not reduce to a great extent. So going forward, the sustained demand from rural areas and anticipated revival in urban consumption. There is the expectation that the urban consumption is going to increase. Expected recovery of fixed capital formation. Fixed capital formation means fixed asset formation. The factories, the houses, they are the asset. The factories, the machinery, tools, equipment, roads, bridges, they are the asset of our country, right? So expected recovery of fixed asset formation, fixed capital formation, supported by increased government capital expenditure. The government is thinking of doing more of the capital expenditure to boost the demand in our country and to boost the production in our country, because the exports are going to reduce, the production is going to reduce. So at least we have to continue our huge demand in our country so that the recession do not enter our country. Okay. Higher capacity utilization. So the companies, the factories, they are utilizing their capacity of production to the higher level, and healthy balance sheet of corporates and banks are expected to support the growth in the country, even though there is the headwinds and the problems that are coming from outside. But in our country, we have enough of the population and enough of the demand. We can continue raising to continue production at a good level and continue the growth in the country. Now merchandise exports, the goods exports, because of the US tariff imposition and because of the trade war that is expected to start, this would decrease, this would weigh down the evolving global economic landscape, which appears to be uncertain at the current juncture. So merchandise export, that is the good exports, it would reduce, it would weigh down by evolving a global economic landscape. It is going to evolve the global economic landscape. It is going to change the global economic landscape because the US has increased the tariff, the China has retaliated, trade war will start, many of the countries will come into the in between this fire. So this good exports, that is going to weigh down because of the, that is going to reduce. So goods exports, they are going to reduce because of the global landscape because of the changes in the global policy that is happening. Now this appears to be uncertain right now because we don't know that what is going to happen. The US is going to take back their decision or they are going to continue with it. What kind of future things will happen, that we are not aware about. This the RBI governor has also said. At the current juncture, we are not aware that what is going to happen in the future, but the services exports are expected to sustain the resilience, and the domestic demand, it is going to support the growth. That we know, that even if the exports, the goods exports, the merchandise exports, even though they will reduce because of the evolving global economic landscape, but still we have enough of the domestic demand and we have enough of the service exports that we will be able to take care of the problems. Okay, on the supply side, so this was on the demand side. On the supply side, while agricultural prospects appear bright, industrial activity continues to recover. That is a good news for our country, and services sector is expected to be resilient also. Headwinds, that is the problem from the global trade disruptions, continue to pose a downward risk, but the main problem is coming now from the global trade disruptions. Okay, so taking all these factors into consideration, it is expected by the Monetary Policy Committee and the RBI that the real GDP growth for 2025-26, so the real GDP growth for the coming financial, for the ongoing financial year, that is the financial year 2025-26, it is expected, it is projected at 6.5%. Now if you remember that in the previous Monetary Policy Committee meeting that happened in Feb, the real GDP growth for 2025-26 was projected at 6.7%. But because of the US tariff imposition, because of the situation at the global level, it is said in the Monetary Policy Committee in the April meeting that we are expecting the real GDP to grow at 6.5%. So that is 20 basis points or 0.2% lower than the previous estimation. So previously we were expecting that the real GDP will grow faster at a 6.7% rate, but now the MPC is expecting that the real GDP will grow at 6.5%. But you can understand that only the MPC has reduced the real GDP growth forecast by only 0.2%. That means we are expecting that our domestic demand and the service exports will be able to cater to the problem and handle the problem, as the Indian economy is considered a very, very resilient economy. Okay, so in the MPC Feb, the real GDP growth for 2025-26 was projected at 6.7% in February, but now in April the real GDP growth for 2025-26 is projected at 6.5%, that is 20 basis point or 0.2% lower. Now coming to the inflation, so this was regarding the growth. Now in the inflation criteria, we are seeing a very good situation in our country. So CPI headline inflation, that is the CPI inflation or the consumer price index inflation, that is the inflation that affects the consumers. So it is the consumer price index inflation, that is the inflation that is affecting the consumers. It is declined by a cumulative of 1.6% during January-February 2025. So from December 2024, the inflation in December 2024 was 5.2%. Now it has declined to 3.6% in February 2025. So you can understand that our target is 4% of inflation. The CPI inflation target is that we want inflation to be around 4% within the range of 2% and 6%. That is plus minus 2%. We don't want inflation to go below 2%. We don't want inflation to go above 6%. So we want inflation to be around 4%, and the inflation in February 2025 has come down to 3.6%. That is even lower 4%. So that is the good news that RBI is able to control the inflation in the country, and the inflation is seemingly good. It is like around the target. So we are happy that it is not increasing, because that would have been a very big problem then. Now why this has happened, why the inflation has reduced so much in our country and it has come near to the target that we want. So on the back of a strong seasonal correction in vegetable prices this year, food inflation dropped to a 21-month low of 3.8% in February. Now the food inflation is controlled, due to which the consumer inflation has come down to 3.6% in February 2025. Fuel group continued to remain in deflation. That means the prices. Now in the food inflation, in the food category, the inflation is reducing. And the inflation is at a 21-month low of 3.8%. So that means prices are rising in the food category, but they are rising very slowly, only by 3.8%. In the fuel group, actually the prices have started to decrease. That means there is a negative inflation. that is also known as deflation. There is deflation that is happening. That means negative inflation. That means prices are actually decreasing. That is good news for us because we import a lot of fuel. So if fuel prices are reducing, we will be able to get very cheap fuel. Okay. Core inflation means inflation that is excluding the CPI inflation, excluding fuel and food prices that are the volatile prices. So core inflation is the CPI inflation excluding the volatile prices, excluding the fuel and food prices. So core inflation, they remained steady in December 2024, January 2025. They increased up to 4.1% in February 2025. So 4.1% of core inflation. So core inflation, that is the inflation, the CPI inflation excluding the volatile prices of fuel and food. So the core inflation shows the inflation in the manufactured goods usually. So you can understand that manufactured goods, in that there is the, or in the services, there is the inflation of 4.1% that is coming. So that is fine because it is around the target. Okay. So and the gold prices, mainly the gold prices. So core inflation, after remaining steady in December 2024-25, inched up to 4.1% in February 2025. So core inflation increased a little and it increased to 4.1% in February 2025. This is primarily because of the sharp pickup in gold prices, sharp pickup in the gold prices. Okay, so this is why the core inflation has increased a little. Now coming to the next point, that the outlook. So we have understood about the vegetable prices, the fuel group and core inflation. Now the outlook for food inflation has turned decisively positive. We are having a positive outlook in food inflation, that it is going to remain low. There has been a substantial and broad-based seasonal correction in vegetable prices. The uncertainties on the Rabi crop have reduced considerably, and we are expecting that, as per the second advance estimates, there will be a record wheat production that will happen in our country, and higher production will happen of the key pulses over the last year. So a good production in our country, will reduce the prices even further. Okay, so that if the prices are reducing, the inflation will be controlled to a good level. Along with robust and good kharif crop arrivals, this is expected to set the stage for a durable softening in food inflation. The food inflation that was very, very high, 10%, more than 10% it was increasing, now it is going to be controlled to a good level. Though furthermore, the fall in crude oil prices, this further augments well for the inflation outlook, because the fuel prices are also reducing the food inflation. Food inflation is getting controlled. It was increasing up to 8%, 10%. So food inflation is now going to get controlled at a good level, and the fuel prices have started to decrease. So this is a good proposition for our inflation outlook. Concerns on lingering global market uncertainties, but the problem is the global market uncertainties, we do not know that what is going to happen in the future, how the different countries are going to retaliate or going to act. Recurrence, and it can also happen that there can be weather related supply disruptions that can happen. So we expect that, because Rabi crop production is expected to be very good, and we expect that kharif crop production, if it is good, the food inflation is going to reduce. But what if there is a weather related supply chain disruption that happens? Because many of the farmers, many of the food production in our country depends on the monsoon. So if there is any weather related problem that comes, then there can be the problem in the food inflation that can come. Okay, so these are certain problems, that concerns on lingering global market uncertainties, recurrence of adverse negative weather related supply disruptions, they pose upside risk to the inflation trajectory. But the RBI governor, in his speech, he said that the El Nino effect, that is the volatile effect, or that is the weather related negative occurrences, they are not expected much in this year. Okay, taking all these factors into consideration and assuming a normal monsoon, CPI inflation for the financial year 2025-26 is projected at 4%. So that is on the target. Okay, if you remember in MPC Feb meeting, the CPI inflation for the financial year 2025-26, it was projected at 4.2%. So now the inflation, it is expected that now the inflation is going to further reduce. So Monetary Policy Committee in April said that for 2025-26, the CPI inflation is projected at 4%, even below 4.2% that was projected in the previous meeting. So the inflation target is going to get met. Okay, this is the expectation. Now the reason that why the MPC, accordingly the MPC unanimously had voted for reducing the repo rate by 25 basis point by 0.25 percentage, that is from 6.25%, the repo rate is decreased to 6%. So why it has happened? So the MPC noted that inflation is currently below the target. It is currently in February 2025 it was 3.6%. So MPC noted that the inflation is currently below the target of 4%. So supported by a sharp fall in food inflation. Moreover, there is a decisive improvement in the inflation outlook. We expect that the inflation will be 4% in 2025-26. Okay. So as per projections, there is now a greater confidence of a durable alignment of headline inflation, the CPI inflation or the retail inflation, with the target of 4% over a 12-month horizon. So we know that in the medium term, the inflation is going to be around 4%. That is, we are going to meet our target of inflation. So for now, we do not have to worry about inflation. For now, we have to focus on the growth. Okay. On the other hand, so you can understand that inflation is not a problem for now. If the expected situation happen, if the Rabi crop as expected is good, and if the Kharif crop production is good, then the inflation is not a problem for our country now, as per the expectation. Okay. On the other hand, there is the challenge in the global environment that is coming up. Growth is still on a recovery path after the underwhelming performance in the first half of 2024-25, but because of the global headwinds that are coming, we have to focus more on growth now. Okay. So uncertainties remain high in the wake of the recent global volatility. So because of the global volatility, there can be some risk that can arise for the growth, and that's why, see, inflation is well around the target. It is on the target, we can say. So inflation is not a problem for now for the MPC, but the growth is the problem because of the global volatility, because of the global decisions, because of the global scenarios. The growth is the problem, as it is expected that it can reduce. So for now, the MPC is focused on growth because inflation is not the problem. So for growth in the country, the RBI and the MPC have reduced the repo rate, so that at the reduced repo rate, more loans will be taken by the customers. Okay, at the reduced repo rate, the banks will get the loans from RBI, the loan from RBI at a reduced rate. So bank will provide at a reduced rate, the bank will provide the loan to the customers. So customers will take more loan and they will spend more in the economy. So demand will increase, production will increase, and the growth will increase in the country. Okay. So uncertainties remain high in the wake of the recent spurt in global volatility. So growth is the focus right now. So in such a challenging global economic condition, the benign inflation, that is the inflation that is around the target, so that is the reduced inflation, and moderate growth outlook demands the MPC to continue supporting the growth. So right now the focus is on the growth, and that's why the repo rate has been decreased by the MPC. Any confusion here? Now, good point. Decode with Satish. Okay, Satish, good point. Now we will come to liquidity. Liquidity, see, this is all done, right? Now coming to the points, that repo rate has been cut by 25 basis point to 6%. Now, what has happened that moreover, the MPC, the Monetary Policy Committee, has changed its stance from neutral to accommodative. Accommodative stance as per the governor. In the governor's speech, the accommodative stance has been explained. Okay, so see, the governor has explained that neutral stance means that on the basis of the changing situation, the neutral stance means that the RBI can increase the repo rate to control the inflation or reduce the repo rate to boost the growth. Okay, this is the meaning of neutral stance. Accommodative stance means that in the coming period, either the RBI is going to keep the repo rate unchanged, or the RBI is going to, or the MPC is going to reduce the repo rate to boost the growth. So accommodative stance is taken to stimulate the economy, to boost the growth in the economy, Okay, so it has been decided by the Monetary Policy Committee to change the stance from neutral. Neutral stance meant that in the coming monetary policy meeting, the monetary policy can increase the repo rate to control the inflation or reduce the repo rate to boost the growth. But now the monetary policy stance has been changed from neutral to accommodative. Accommodative stance shows the people, shows the market participants, and it shows the economist and such, that the accommodative stance shows that the RBI is focused on growth. So accommodative stance, it shows that the RBI is focused on growth. RBI is either, or the Monetary Policy Committee of RBI, it is either going to keep the repo rate at 6% or it is going to further reduce the repo rate in the coming meetings. Okay, so accommodative stance has been taken by the MPC. Now the stance has been changed from neutral to accommodative. Accommodative stance means that RBI is focused on stimulating the economy. The MPC is focused on boosting the growth in the economy by keeping the repo rate at a previous level or reducing the repo rate further to boost the growth. This is the idea. Now the accommodative stance has been taken. So stance has been changed from neutral to accommodative. That is a big decision to boost the growth and to show the market participants that the RBI is focused on growth. CPI inflation is projected at 4% for financial year 2025-26. Real GDP growth for financial year 2025-26 is projected at 6.5%. Now, as on 4th April 2025, India's foreign exchange reserves stood at $676.3 billion US, providing an import cover of about 11 months. So we have the import cover of 11 months. Okay. Now system liquidity. Many of you are saying that if the repo rate is reduced, there will be more money supply in the economy that will happen. Okay, more money will be supplied in the economy. At the lesser repo rate, the banks will take the loan at the lesser repo rate. So banks will provide the loan at a lesser interest rate. So more people will take loan, more money supply will flow in the economy. More money supply means that if we are doing more demand, we have more money, we are doing more demand, so prices can start increasing. You have to understand that money supply can increase, but at the same time that money supply is kept at a good level by the RBI. RBI has different tools to keep the money supply at a good level. Okay, even you can understand that demand will increase, prices will increase, but with the export decreasing, so demand is decreasing from that end now. So prices are not going to increase much. Even if the internal demand is increasing, with the banks providing the loans at a lesser interest rate, so more people will take loans, more money supply will happen in the economy, more demand, but at the export front the demand is reducing. So the higher demand at the domestic level and lower demand at the international level will be balanced out, so prices will not increase much. This is the expectation, you can understand. Now system liquidity was in deficit. System liquidity, that means money supply was in deficit. It was reduced in January 2025. The system liquidity deficit diminished during the February-March 2025. As you know, the RBI was conducting the open market operation. RBI was providing the money through the open market operation, through the swap facility, and through different, through variable reverse repo rate, through variable repo rate. So this I have explained in a session where we have discussed about managed liquidity. So RBI to boost, so the system liquidity was very less in January 2025. To boost the liquidity, to boost the money supply in the market, the RBI took the open market operation. The RBI did the swap facility and the variable repo rate facility, where more loans were given to the banks under the variable repo rate. More loans were given to the banks at a variable rate. Okay, so this is the idea that the deficit in the liquidity, it diminished and it became surplus on 29 March 2025. So coupled with the government spending, the government was also spending more. In the later half of the March, the system liquidity further improved and it stood at a surplus of 1.5 lakh crore as on 7th April 2025. Okay, so whenever the RBI has to boost the liquidity, RBI has to increase the liquidity in the economy to boost the demand. The RBI can also take the additional steps like doing the open market operations, okay, purchasing the government security and providing the money and the rupees to the banks, doing the swap facility where the RBI bought the dollars and sold the rupees, and so rupees was provided to the banks and rupees was provided to the economy. And the RBI also did variable repo rate, where more loans were provided to the banks at a variable rate. So more loans to banks means more money with the banks, more money supply in the economy. So this was the idea that when system liquidity was in deficit, to boost the system liquidity, to boost the money supply, RBI took various measures. Okay, any confusion anyone has till now? I have told you that if we have more money supply, yes, the demand will increase. More liquidity, more money supply means more demand, prices can increase. But you can also understand that demand is reducing from the export front, na? So external demand is reducing. So we have to boost the internal demand, and from one side the demand is reducing, from other side it is getting boosted. So that is going to balance out. So prices might not be affected much. Okay. Okay, now this is the first question. I hope you will be easily able to answer this question. Now before going to the second question, let me show you that if you if you want to do the answer writing practice and you are not able to practice by yourself, you are not able to understand that how to write the answers and from where to get your answers evaluated. So there is the Perspective 360-degree series that EduTap conducts on Monday, Wednesday and Friday at 5 p.m. Okay, and in this Jaskran sir takes the session where he discusses the questions with you, where he discusses the important material with you, and then he also gives homework question that you can comment down below and that gets evaluated. Okay, that also gets evaluated. So this is the idea. Now this is the first question. I hope you will be easily able to answer this question, and this is the second question. I hope you will be able to answer the correct statements here. Okay, in the second question. So thank you everyone. If you have any query, do write it down in the comment section. I hope you enjoyed today's session and I hope you want me to bring such detailed session. So do tell me if you like these detailed session, or do you want me to just cover the important points? You want me to just cover the important points, because in today's session I have even explained you about repo rate and about the SDF and the MSF, and I have gone to the nitty-gritties, but they are the static. So sometimes I am afraid that if I pick up this if I explain you this static material, then the sessions get lengthy. So do you want me to do this explain you the static points also, or do you want me to just focus on the current affairs? Okay, so just tell me if you are fine with this detailed session, because many a times I see that why the sessions are lengthy. So you can tell me if you want the small sessions, I can bring the small sessions only. That is I will focus on only the current affairs point. Okay, if you have any query, do write it down in the comment section and do give me the right answer of the homework question. Thank you everyone. Thank you for joining. I hope you enjoyed the session. See you in the next session.